Okay, we're just doing pages 70 to 83 in chapter 2. So that's only 13 pages, but this seems like kind of a lot. So first of all, I want you to get your book and pause me, go get your book and turn to page 97 because the numbers that I'm going to be using this PowerPoint are from the mini case on pages 97 and 98. And I think it will be easier for you to follow along if you have the book. You can track where numbers are coming from. But so chapter 2 is a review of financial statements, and that's what you did in financial statement analysis, so we can skip the whole first part of this chapter. But what's new in finance is changing those accounting statements to free cash flow statements. And so that's what we're going to learn to do on pages 70 to 83 is how to get to free cash flow statements because free cash flows are what we need. And so in the big picture, we've looked at this before. So sales minus operating costs minus required investments in operating capital, and we'll define all this stuff, give you your free cash flow. And then that becomes the numerator in this valuation equation. So starting with the income statement at the bottom of page 97, we've got 2 years of income statements here. Okay, and so you can see that even though sales increased by a lot, 2.4 million in 2016, they lost money. Okay, and so, but the real question is there any cash coming out of this company? So here's a picture of their balance sheet, and this is at the top of page 97. And so current assets, total assets, and then here we've got the liabilities and the equity. Okay, and so again, you can see that total liabilities and equity went up by a lot, just like the sales did. So what is free cash flow? Free cash flow is what you have left over after you have funded everything that needs funding in the company. So from the income statement perspective, you've paid all your expenses. That's reflected in the income statement. And then from the balance sheet perspective, you've bought all the assets you need to buy. So by definition, the cash flow is free because it's left over after you've done all of the above, and that includes paying a dividend. So all of your expenses, paying your dividend, buying any assets that you need, is there any money left over after that? And we focus on free cash flow because that's what a company's value depends on. If a company is only earning enough money to keep itself going, so it reinvests everything it makes in the company, there's nothing available to investors. And so free cash flow is what the company throws off for other uses. So, like what? Well, you could pay off debt. So you could pay interest on the debt, you could pay principal on the debt, you could pay more dividends, you could buy back stock. You could invest in other companies. So from a purely maximizing shareholder wealth standpoint, probably the firm should be paying out free cash flow as dividends. We don't see a lot of firms doing that. We find them using their free cash flow for lots of other things, and this is the one where you can get into trouble when they start buying other companies and they don't necessarily know how to run the other companies. And so you see a lot of value destruction down here when the free cash flow is used to buy other companies. So this looks scary, but it's really not. My job is to keep you calm through all of this. So to calculate free cash flow, we are basically changing the financial statements to focus just on operations. So we're going to leave out things that managers, line managers would have no control over. And specifically, that's financing decisions. So on the income statement, so if you flip to page 98 and look at your income statement, so we go to earnings before, whoops, sorry, it's on 97. So earnings before interest and taxes, EBIT. Okay, and so what that is we're leaving out the interest expense. And the idea here is that we want to try and get measures that managers have some control over so that if we need to fix something, they can. And the financing decision is not typically a line manager decision. That's made at the corporate treasury level. So this is a measure of operating earnings. So that's why it's called net operating profit, operating after tax, and we call that NOPAT. So NOPAT is calculated as EBIT times 1 minus the tax rate. Okay, because taxes are certainly a cash flow. So that's the income measure, NOPAT. And then we want to look at the assets. So we want to go through the balance sheet and pick out what's operating and what's not. So we want to identify the operating current assets and the operating current liabilities. And so operating current assets minus operating current liabilities gives you net operating working capital. And we'll be going through all of this, more definitions and numbers. The net operating working capital plus any operating long-term assets, and so that would be typically the thing called fixed assets on a balance sheet, gives you what we call total net operating capital, or TOC, total operating capital. And then what we want to know is, how does total operating capital change between 2 years? So this year's total operating capital minus last year's tells us if we made any investments in operating capital. Okay, so this one is the change between 2 years. This one is the NOPAT for a year. And so free cash flow is our NOPAT minus the net investment in operating capital from right here. Okay, it's really not as scary as it looks. So if you look at the income statement on page 97 and identify EBIT there of 209,100, or wrong year, 17,440. Okay, in 2016 it was 17,440 times 1 minus T gives us this, and in 2015 it was 209,100 times 1 minus T gives us this. On NOPAT we really only need the current year. We don't really need this for anything. So then looking at the assets, so operating current assets are the ones that are used to support operations, and so they typically include cash, inventory, receivables. They do not include marketable securities or short-term investments because those aren't part of operations. So again, we're trying to focus just on what's used in operations. The operating current liabilities, and I call these NIBICLs, non-interest bearing current liabilities. Okay, NIBICLs include typically accounts payable and accruals. What they don't include are notes payable, because those are interest bearing and that's a source of financing and it's not part of operations. Okay, so we want to focus on the NIBICLs, non-interest bearing current liabilities. So if we look at the balance sheet on page 97, so if you just look down there, okay, cash we want, short-term investments we don't want, accounts receivable and inventory we do want. So this is cash, accounts receivable and inventory, and that's 1,317,842 in 2016, and it's 793,800 in 2015. Okay, and so then to that we add the net fixed assets, and so that's just taken straight off your balance sheet. You've got gross minus accumulated, so your net fixed asset picture, your net fixed asset number, 263,160, 939,790. Sorry, I was looking at the depreciation. So 939,790 is the net assets. So this is your operating working capital, operating current assets minus the NIBICLs, plus net fixed assets. So this is the total money we have invested in assets, net assets, in 2016. So the idea of subtracting the NIBICLs here is that those things helped pay for current assets. And so when we're looking at investment, we're looking at how much did the firm have to come up with besides other money they came up with. Okay, so our operating capital in 2016, 2,257,632, and in 15 it was 1,138,600. So obviously there was a big investment in total operating capital. So our free cash flow calculation then is our NOPAT minus the change in total operating capital. So this is the 16 minus the 15 total operating capital number. So our free cash flow is actually negative because we invested so much money. So we had a little bit of positive NOPAT here, but we spent a lot of money on assets, 1.119 million, and so we have negative free cash flow. So how do you suppose investors reacted? Well, it depends. They're investing a lot of money, and so if this is if they are like changing technologies or they're investing for a new line of business, this isn't necessarily bad, because you have to invest before you get the return on your investment. And so you kind of have to know the reason for why is there a negative free cash flow, and certainly you don't want year after year after year of negative free cash flow. So uses of free cash flow. So we can look at the financial statements and figure out how that where that negative 1.108 million is coming from. So if you look on the income statement, they had interest of 176,000, and so this is 176 times 1 minus t. So interest is tax deductible, so we care about the after-tax amount of the interest. So this is the 176 times 1 minus t, so that went out. Then if you look at their debt, so their notes payable went from 200 to 720, so that's a $520,000 increase, and their long-term debt went from 323,432 up to $1 million. So between the two of them, they borrowed a lot of money. So we had an inflow of 1,196,568. So they borrowed a lot. They paid 11,000 in dividends. And if you look at the short-term investments, they went down from 48.6 to 20. So that means they sold short-term investments, so that's an inflow. And so all of this equals the negative free cash flow that we had. And so basically the debt is covering the negative free cash flow that we had to pay for all those investments that they're making. So we can look at various measures of profitability. So one is the operating profitability ratio, and that's simply NOPAT divided by sales. In your last class, you probably looked at profit margin. And so this is similar to profit margin, but we're just looking at the operating numerator, okay? So their operating profitability went from 2.5% in 2015 to 0.18% in 2016, okay? So expenses were up, and the operating profit margin fell. Looking at the investment in assets, total operating capital divided by sales. So our total operating capital was this divided by sales in 16, so 38.7%, and it was only 19.5% the year before. And so capital requirements went up, which means that it took more assets to generate $1 of sales, or the capacity utilization got worse in 2016. So ROIC is the kind of overall measure. This would be like return on assets from your last class, but again, only focusing on operations. So we have NOPAT divided by total operating capital was 0.5%, and ROIC in 15 was 11. So obviously ROIC fell because operating profitability went down and the capital required went up, okay? So the firm's cost of capital, its overall average cost of raising money, is 10%. So did this growth add value? And the answer is no. You can't raise money at 10% and invest it at 0.5%. That's what we call negative net present value. So you're destroying value in this scenario. So the investors didn't get the return they require. And as I said, high growth usually causes negative free cash flow, but the ROIC has got to be greater than the WACC. Okay, so you can have negative free cash flow, but you could still have a positive relationship here. If the ROIC falls below the WACC, then you are destroying value. Economic value added is a number that we can use to evaluate performance. So a big problem in finance is, how do you evaluate performance? You try to get managers to do what the stockholders would want them to do, but there's all kinds of ways around that. If you tie compensation to the stock price, we read all the time about examples of firms cheating by withholding information, doing illegal things, manipulating earnings to make the stock price go up in the short run so they get their bonus, and then truth comes out and the stock price falls. So we're always looking for measures that can make managers behave like we want them to. And so economic value added is such a measure. So economic value added is simply NOPAT minus the capital charge. And so the capital charge is how much money do you have tied up in capital, and what is your weighted average cost of capital. So this is what you've got to be earning more than to get ahead. So if we look at the economic value added for the 2 years, so our NOPAT was this, cost of capital times the total capital, so this is our capital charge, and so clearly we had negative EVA in 2016 and we had positive EVA in 2015. Okay, so negative EVA is not a good thing. So what happened to the stock price? Well, the stock price went down to reflect all of this bad news. Earnings per share were negative because net income was negative, and the dividend was cut in half. And so they were clearly trying to save some cash by cutting the dividend in half, but then that sends a bad signal as well. So basically, this is a bunch of bad news for this company. So we can also look at market value added. So market value is the market value of the company in the financial markets minus the book value. And so technically market value is number of shares of stock times the stock price plus the market value of the debt. And then the book value would be the value of common equity on the balance sheet plus the value of the debt on the balance sheet. In practice, the book value and the market value of debt are typically close, so we ignore them. So market value added then becomes the market value of the equity. So this is stock price times number of shares minus the book value. And this is the real measure of, are we creating value? And so if we look, the market value of the equity was 600,000 they've got the numbers wrong here. This should be 16. Let me change it right now. Okay, so the market value of the equity in 16 was 600,000, and the book value of the equity was 557,632, and so they have a little bit of market value added, but they had more in 2015. Okay, so all of this is trying to get to reconcile the financial statements more with the stock price is basically where we're going with this. Okay, so this is a focus on operations because all of this then are things that managers can control and do something about to try and improve them. And then ultimately we're going to take these free cash flows and valuations down to the stock price.